Morning Baker investment students. It is Sunday, June 11th, 2023. So I hope everyone had a great weekend. A little bit cooler weather here if you're in the Kansas City area. We had a little bit of rain this morning, so I was out walking. It was kind of nice to have that refreshing rain here to cool things down a little bit. But for this week, what you'll do is you'll be doing your continuation of your portfolio postings and discussion. You'll focus a little bit more this week on the beta and calculating a weighted beta for your portfolio and read through the textbook about how to do that. And then continue to post, see how we do this week. I know the Federal Reserve is going to make us some announcement, the FOMC this week, about interest rates. So kind of pay attention to that, see what happens to the markets. But in addition to your forum post, you'll also have some homework problems from chapter 5 and 6. This is going to tie it into portfolio market returns, the standard deviations of these returns. You're going to look at the CAPM model, which I'll talk about a little bit, and some financial ratios to look at performance of stocks. When I think of financial ratios, you're looking to see how is my company doing, how are we doing over time, and probably more importantly, how are we doing to our peers, because investors are going to look at this. And obviously, if the company is doing well and they have strong, solid financial ratios, they're more likely going to be recommended as a buy. Again, there's no guarantee of future returns. Things can turn on a dime in markets, or financial ratios doesn't tell us about prediction of future cash flows and whether that product is still in demand or not, or a better competitor comes along. But at least gives us some good insight to make some logical decisions about whether we want to buy this stock or not. And you also have a quiz this week covering what was in weeks 1 and 2. So make sure you just sit down in a time period where you have access to your textbook. It's reduced distraction, and then you can get that quiz done. So other than that, I'm going to give you a little bit of insights into this week with Chapter 5. Obviously, I put the video out there, William Sharp. He was kind of the rock stars of finance, along with Harry Markowitz in the modern portfolio theory. But William Sharp received the Nobel Prize in economics for his work on the capital asset pricing model. Essentially, the model says you take the risk-free rate, which is like a treasury bill, say if that's at 3%, and what you do is you add to it beta, and within parentheses, the difference between the market return and the risk-free rate. So it's the idea that you should be expecting some type of additional premium based on the beta of that stock multiplied by the difference of that risk premium between the market and the risk-free rate, and plus adding that risk-free rate. So again, it's risk-free rate plus beta times the difference between the market return and the risk-free rate. Okay. Obviously, beta is a measurement of the volatility of the stock price and returns over a period of time. If we looked at a 6-month trailing beta, what you would do is you would compare the S&P 500 to that specific company's return. So if I was looking at Kellogg's, I looked at, if I had invested in Kellogg's and what was the return on paper with Kellogg's versus the S&P 500, I want you to think of the S&P 500 as the independent variable, the X variable that's moving up and down, and the Y variable, the response, is the returns on the stock. So say Kellogg's. So if you have a beta equal to 1, it says if the market goes up 10%, then your stock goes up 10%. And if the market goes down 10%, on average, your stock goes down 10%. If you have a beta equal to 0.5, it says, hey, if the market goes up 10%, then your stock goes up 5%. If the market goes down 10%, then your stock goes down 5%. So it's less reactive to the market. There's less response. But if you have beta equal to like a 2, like something like a Tesla, it says, hey, if the market goes up 10%, then my stock goes up 20%. And if the market goes down 10%, then my stock goes down 20%. So it's much more volatile, and hence you would have a higher expected rate of return with the capital asset pricing model. And William Sharp will also go in through, and you'll read in the textbook about the idea of diversification. That's a lot of what these chapters are about, especially chapter 5. The traditional approach might be that you just pick very good stocks and a good track record, but modern portfolio theory with Markowitz says, hey, let's try to pick a portfolio that gives the maximum return with reducing the risk. And obviously that's looking at standard deviation. So portfolio managers, big companies like American Century, Fidelity, the ones that manage these mutual funds, are utilizing some of this theory to try to reduce the risk of these portfolios to give the best return for the least amount of risk. But a lot of times that prospectus will tell you about the types of risks that the managers of the portfolio are willing to take on. Another good thing if you're investing in a mutual fund, also look at how long the managers have been with that fund. That's kind of a telltale sign too about some of the risk you're taking on, because some of them may not be as experienced if they're just in the first couple of years of running that fund. But one thing I want to point out with that beta too, I want to make sure this is very clear, that beta does not equal slope. So if you're reading that through the textbook, and even if you see this slope, again, the idea of beta does not mean slope, okay? Especially when you're going to be looking at things like the security market line, okay? Chapter 6 is going to look a lot at stocks in general, different types of stocks, the returns of stocks over the years. Of course, we can look at returns relative to the dividends, and you'll notice that dividends have paid less over the years, but most people invest in stocks, what we call the capital gains. That is, that you buy it at a lower price and the ability to sell it at a higher price. And if you look at the returns historically on the market, historically the S&P 500 market's averaged about 10%. Again, it doesn't mean that every year is going to give 10%, but you're going to have some years that are really bad, like we're in COVID. You have the years that were really high. Right now, we're kind of waiting to see what happens in 2023, whether it will be a good year or not. But again, relative to bonds, bonds might have averaged historically about 5%. Common stock has averaged about 10%. But investors sometimes also invest in bonds too, because they want that income, because the stocks don't necessarily provide the income in terms of dividends that a bond would. So a lot of it also depends on your strategy, what you're trying to do, what your time period of life, or the organization's time period too. But again, you're going to look at some of these common uses of stock. That's what a lot of this chapter goes through, how you look at the information, why do companies issue stock. So, all right, I'm going to try to keep it a little bit briefer this week on the video. So that's all that I wanted to share for this week, to give you a little bit of insights. But again, if you do have any questions, do email me. I do appreciate it. I've received some questions from you all, so this is good. I know we have a small cohort, but love to hear from you. And good job to keep posting with the forum discussions. I was able to jump in this morning and post some comments back to you all, so I try to do that every week for all my students. So other than that, have a great week, and I look forward to what you're going to be posting later in the week. Take care.